Hello guys, this is Mayank Kothari. Today we are going to start a new chapter, that is security analysis. This is going to be the third chapter of your syllabus. The first two chapters have been completed. You might be thinking that the first chapter has not been taken by me, but still I'm saying that we have completed the two chapters. But let me remind you one thing, that before starting the lecture itself, I told you that the theory has to be covered by you in any case before we start the practical questions. So I'm assuming the first chapter's theory has been completed by you. I'm assuming the second chapter's theory has been completed by you, and the same thing I'm assuming with the chapter number 3, security analysis. So before starting the chapter, I should remind you, or I can say that I will give you certain advice if you want, or otherwise you can skip that also. Do not repeat the mistakes. If you are able to learn from the mistakes of the others from a certain book or a video or any audio podcast or something like that, just learn from those things and do not repeat those mistakes. You can save the time that the people have invested learning, doing those mistakes and learning from them. So if, let's say for example, if I have compiled my all the mistakes in a particular book, and if you read that book, you can save all that time which I invested doing those mistakes, because that will be of no use, no? So a wise man has already said that thing, that you can improve upon your life, or you can move ahead of that person if you are able to, or if you are getting an opportunity to learn from the mistakes of that person. So that's what I'm telling you. There might be certain age gap between you and me right now. I'm assuming that the age gap is around 10 to 12 years. You might be of 20, 21 or 22, and I'm 32 right now, okay? So my mistakes from my student life and the mistakes of you from your seniors life, that means my previous students, you can say, I'm giving you this advice of reading the theory first with all that experience, and which is going to help you a lot. So it's up to you now how you do that. Okay, so understand that the theory chapter, the security analysis chapter can be asked in exam for 4 marks or 8 marks. So if the 4 marks question has been will be asked in the exam, it will be a theory question. Mostly the chances are like that. The 4 marks question will be asked for a theory question, and practical question will be asked for around 8 marks. So that is what the scene is. But before starting the chapter, we should revise the entire thing, or the formulas that we have learned till now. So let me just start with the formula book. I hope you have the formula book ready with you. Every time you watch the lectures, you should be ready with the formula book, okay? Formula books, or you can say charts, or if you have your notes. So the very first thing that we should start with is the time value of money. You can clearly see that we have 6 things in the time value of money. You should be able to remember the formula by looking at the index. It's like simple interest is written over here. You should be able to write the formula here if you can. Right now I'm just going through our page number 1. Okay, let's start with the revision of the formulas, and then we will shift to the security analysis chapter. So the first formula is simple interest. Simple interest is equal to principal into rate of interest into time in years. Now understand one thing, if this rate is in per annum, the time should be in per annum as well, okay? Compound amount gives you the benefit of compounding. So compound amount is equal to principal in bracket 1 plus rate of interest per annum divided by number of compounding to the power nt. So n is the number of compounding, r is the rate of interest per annum. If this rate of interest is in per annum basis, the number of compounding should be also in per annum, and t is also should be represented in per annum. So everything has to be in per annum basis. Effective rate of interest is equal to 1 plus r divided by n to the power t minus 1. If you will remember, if you will understand, effective rate of interest formula is derived from the compound amount formula itself. If you remember the derivation, we shifted this p on that side, okay? We shifted this p on this side. So compound amount divided by principal, then compound amount is also equal to principal plus interest. So principal plus interest divided by principal was this, and principal plus principal was 1. So in this effective rate of interest formula, I will request you to just mark a like put a red arrow here or any kind of arrow here and just write down 1 represents P by P, principal by principal. Why I'm telling you to write it down here is because this will remind you of the derivation of the formula. That is going to help you for sure. Okay. Next comes the present value and the future value. If you will understand this, future value is equal to present value. Future value is equal to present value in bracket 1 plus r divided by n to the power nt. If you will just go through it, this formula is nothing but the compound amount formula, where compound amount has been replaced by future value, and the principal which we invest today has been replaced by the present value. So the same formula you can continue for on and on, and you will get the present value is equal to future value into present value factor. Okay, let me just move ahead. To this present value of annuity. Why annuity? What is annuity? Annuity is a figure which is like repeated for like 2 years, 3 years, or 4 years. If such is the situation, you can calculate the present value of this figure. Present value of this figure by just taking it one time and multiplying it with the summation of all the present value factor, which is called as present value annuity factor. Value of perpetuity is equal to periodic cash flow divided by rate of interest. You should understand one thing, that if the cash flow is per annum of represents 1 year, the rate of interest should also represent 1 year. If the cash flow is of 6 months, the rate of interest should also be taken as 6 months. Okay. But one more thing to add on that is, if the periodic cash flow is received at the end of first year or first period, then the value of the perpetuity is calculated for 1 minus n period, or we can say n minus 1 period, 1 year earlier, or we can say at 0 time. If the cash flow is of the second year, the perpetuity value should be for first year end. So the value of the perpetuity will always be n minus 1. N minus 1. Okay. I told you that the basics means the ratios will be taken later on in every question whenever they will come. Most of the questions from this will come in security valuation and corporate valuation and mergers. Okay. Then we started with the risk management chapter, and if you will remember, the formula doesn't start from value at risk. The concept starts from the Z formula, this formula, to standardize a normal variable, z-score formula. I told you the derivation of this formula, that z-score is equal to x minus mu by standard deviation. What is this x? X is the figure where we want to reach, and mu is the figure from where we are starting. This is the mean. If you remember the 14th question of risk management, mu was 2 crores of the profit and x was minus 1 crore of the profit, means 1 crore of the loss. So we had to reach from 2 crore of the profit to 1 crore of the loss. So the numerator was coming like this: minus 1 minus 2, that is minus 3, divided by the standard deviation, which was 1.6 crore. So the entire figure was coming something like 1.785 or 985. Okay. So that is the z-score, and we found that in the z table, and then we arrived at the probability of happening of those events. So on the right side, entirely right side, 96.06%, if you remember, 96.06% were the chances that the maximum loss will be 1 crore, and 3.04% were the chances that the minimum loss will be 1 crore. From this formula itself, x is nothing but var, the loss that we want to know the probability of. And whenever we put x is equal to this var, mu should be 0. So mu always comes to 0 in that, unless otherwise given, and the formula becomes z is equal to var divided by standard deviation. And when we transfer this standard deviation on that side, we will see the formula like this: z score into standard deviation is equal to var. And from this logic only, we have arrived at this formula, that var is equal to z-score into standard deviation. If you want to calculate the standard deviation for multiple days, then we can just take the standard deviation for 1 day and multiply it with under root whatever days you want to calculate. So let's say suppose var of the 10 days have to be calculated. So var of the 10 day, var of the 10 days is equal to z score into standard deviation of 1 day into under root 10. Another thing is z score into standard deviation of 1 day also becomes var of 1 day. So for var of 10 days is equal to var of 1 day into under root 10 can also be done. Standard deviation for multiple days is nothing but standard deviation of 1 day into under root that much of the days. Let's say for example standard deviation given in the question is in weeks. Okay, so 1 week standard deviation is given to us and we want to calculate the standard deviation for 250 days, means the entire year. At that time, if the standard deviation is given in weeks, under root t should also be written in weeks, not days. Understand that the format or the base of both should be either days, weeks or months. Okay, portfolio variance. We learned about this formula variance in the basics before risk management chapter, and but in that formula we used the weights because variance was calculated at that time in percentage. Now standard deviation of a square, why we have written in currency here? Because portfolio variance when calculated in currency doesn't need weights. I gave you the example of that and we proved that we do not require weight whenever we calculate the variance in rupees, dollar, euro or something like that. Variance is equal to standard deviation of a square plus standard deviation of second investment square plus 2 into both the standard deviation into correlation coefficient between the two stocks. Weights are not required in the formula above if the values are in rupees or any other currency. We use weights when the values are in percentage in portfolio management chapter. Good enough. Now comes the last part, which is portfolio VAR. It is similar to portfolio variance. If you can see the formula, portfolio VAR square is equal to VAR of A square, means the first investment, the second investment square, 2 into multiplication of the VAR of the both the investments and correlation of AB. Also we can use this formula as well for VAR calculation. What is the formula? VAR, portfolio VAR is equal to z score into standard deviation of the portfolio. Okay. Now let's move on to the new chapter, which is security analysis. Please understand clearly that there are first three formulas on which there are no practical questions in the institute syllabus, no suggestions, and it has never been asked since 10 years. So we are also not taking it in the fast track batch, first of all. Second, you just need to go through the formulas in case something is asked in the exam. So I will not say 100% that nothing will be asked on these these concepts, but the chances are only 1%. Okay, so let's first go with the absolute breadth index. If you will see the formula, just a second. Absolute breadth index. The formula is number of advancing stocks minus number of declining stocks divided by total issues traded. What does that mean? Let's say for example you have 50 stocks in your portfolio. Okay, out of 50 stocks, 30 stocks are going up, has gone up for the day, and 15 stocks have gone down. So 30 stocks who has resulted in a positive price change, and 15 stocks who has a negative price change today. So 30 minus 15 will give you 15 divided by total issues traded. That means 50. Okay, instead of that, let's just write down. So I will just write down 30 here minus 15 divided by total 50. So you might ask that, sir, these are 30 which are going up. The ones which are going down is 15. So total is only 45. Where are the rest of the 5 stocks? Because you have written total as 50. So there are some stocks which may not change through the entire day. So if they started with 20 rupees in the opening session, they are closing with the 20 rupees in the closing session. That means there is no change. Okay. So what do you mean by ABI, absolute breadth index? Total issues traded is equal to advancing stock plus declining stock plus stocks with no change. So there is one correction in the formula book that you should note: stocks with no change. Stocks with no change. Okay. So this will give you an idea of whether the entire portfolio is going up or down. See, if the advancing stocks are higher, the figure will be positive. If the declining stocks are higher than the advancing stock, the figure will be negative for the ABI. That's the only thing. Accordingly, the graph will move. The second thing is confidence index. See, ABI was mostly for the shares and this is mostly for the bond. So if you will have a look, what you have to do is you have to calculate the YTM of best grade bonds. Best grade bond means top class bonds with good rating from the credit rating agencies. Okay. And what you have to do is you have to calculate the return of those all those bonds and calculate the average after that. YTM means yield till maturity. You will learn about YTM in security valuation chapter. So you take the total of the returns of all the best grade bonds and calculate the average of that, write it in this formula. Then you take the intermediate grade bonds, means the lower class bond, the lower class than these bonds. So intermediate grade bonds, take the return of all those, do the total of all those, and then calculate the average of that. This will give you the confidence index. Okay. Then comes the RSI. RSI means the relative strength index. How much is your stock? How much you can rely on your stock. So percentage change in stock price divided by percentage change in index is the formula. What does that mean? See, first of all, let's understand about the index. You might see something is written over here. I wrote it while I was taking Hindi fast track batch for this chapter. So index in India, majorly there are two stock exchanges, National Stock Exchange and the Bombay Stock Exchange. For a National Stock Exchange, the index is Nifty. For the Bombay Stock Exchange, the index is Sensex. Okay, so these are the change in the Nifty or Sensex is represented by percentage change in index. So for example, let's say on that day the index moved up by 10% and the stock that I purchased moved up by 10% as well. So 10 divided by 10 will give you 1 RSI. 1 RSI means my stock is as strong as the entire economy, because index entire this represents the economy of the country. Okay, so my stock is as strength, or we can say as strong as the entire economy. But if let's say for example the stock price changes 8 and the index percentage changes 10, so at that time the result will be 0.8. At that means that my stock's strength is little lesser than the entire economy. So entire economy stock will be strength will be 1 as a base. Okay, this is all about a basic knowledge that you have. There are no practical questions in entire syllabus and have not been asked in any exam, RTP or anything till now, but there are certain questions on the moving averages. So this is what the concept that we are going to start with. Just a second. Now we should understand what are the moving averages. First of all, we will understand the moving averages, then we will get to know. Just give me a second. So first we will learn what is the meaning of moving average, and then we will see what is the arithmetic moving average and the exponential moving average, and then we will understand about these formulas, both of these formulas, and then we will calculate the solve the practical questions. So I will just take it out of the screen and I will just start with the have a look on this screen now. Let's say for example I take a stock. I have purchased the stocks of Tata Motors, or let's say ABC Limited. Okay, and days like yesterday, 2 days back, 3 days back, 4 days back, 5 days back. Okay, in a sequence like this. And today is 0 day. Today is 0 means today. Okay, so the stock price, let's say the stock price of ABC were somewhere like this, somewhat like this, 46, or I can say it started with 40 rupees, then it went down the very next day, that is to 38, then it came up to 41, 44, 46, something like this. Okay, that's cool. Okay, now let's calculate the average price, simple moving average. This is what we are going to call simple moving average or arithmetic moving average. And how to do that? We will just have to add all the prices of previous 5 days and divide it by 5. Isn't it simple? It's very simple, sir. Okay. Let's just do that. 46 plus 44 plus 41 plus 38 plus 40 divided by 5. So it gives us something like this, 41.80. That's okay. It's very simple to calculate the arithmetic moving average or simple moving average. The formula is also very simple. Whatever is given in the formula book, you will be able to understand it now, that it's nothing but the total of all the prices divided by the number of observation. If you are calculating the total prices of 5 days, divided by 5. So that is the average price. Now understand the meaning of moving average. Moving average is a term or a concept which is used in order to analyze the past prices. Now the chapter that we are learning is security analysis. So analysis is something which we need to focus on. Moving averages is a part of that analysis. Moving averages is a concept where we analyze the past prices of the stock and then estimate the future prices so that we can take a decision whether to buy the stock or sell the stock, whether the market is going to go up or down. Okay, so such type of decision has to be taken, and for that analysis is required, and that is what we are doing here. So you are okay with the concept of moving averages? Then comes the simple moving average. We are done with the concept of simple moving average. But there has to be certain problem or a drawback with this concept. Otherwise, there was no need for the second concept. One was enough. But there was some drawback. There is some drawback in the simple moving average. Sorry about the grammatical mistake. There is some drawback in simple moving average and arithmetic moving average. Before writing it down, just give me another example which is very familiar to us. Let's say I'm standing here today. I'm recording the fast track batch. You are watching the classes. The very next month and the very next month, the next month and the very next month, I can clearly say that what I'm going to do in the coming 2 months. I'm going to record the fast track classes which will be in Nagpur city. So I will just wake up, come to office, record the classes, handle the office, play cricket in the evening, and then go back to home, spend time with my daughter, my wife, and then we'll have dinner, we'll do some masti fun and all that thing, and then I will go to sleep. Might be in between, before just before going to sleep, I might read couple of pages from the novel. Okay, so that is what I am doing, and that is what I will be doing for the next 2 months. I can clearly say that. So I can easily estimate what I'm going to do in the next 2 months. But my question is, can I estimate with the same confidence percentage or confidence level what I'm going to do after 3 years in these months? No. Even you can't estimate it. You can't tell me with the same level of confidence what exactly you are going to do after 3 years. Right? So it is very easy for me to predict what I'm going to do in the next 2 months than predicting what I'm going to do after 3 years. Because understand, whatever I'm doing in this month has a very strong relationship with what has just happened or what I'm doing right now. But what I will be doing, whatever I will be doing after 3 years, might have little to no relation with what I'm doing right now. So basically this time, the zero time, whatever I'm doing right now might not be important for the prices of this time. But this is very important to predict the prices of the stock at this time. So the recent prices is very important to predict the current prices or the future prices, but the past prices means the like oldest price will not be of that much important to predict the future price. Are you getting it? So in my example, if I want to calculate if I want to calculate if I want to calculate the price today, the 46 rupees or the 44 rupees is very important for me than 40 rupees and 38 rupees, because this has become the part of the like old days or the past days, which may not be that important. Yesterday's price is more important for me than the fifth day's price. Are you getting it? So the problem with simple moving average is whenever we divide it by 5, we are giving the equal probability of happening of this price. We are giving equal importance to each of the price in the numerator: 20%, 20%, 20%, 20%, and 20%. Do you think we are doing right? We are giving the probability of happening of 46. We are saying that probability of happening of 46 rupees is 20%, and the same is the probability of happening of the 40 rupees price. It is not fair enough. So we should give more probability to the recent prices. Do you agree with me on that? If we want to calculate the price on this date, we should give more probability or more weightage to the recent prices than these prices, right? This is the drawback of simple moving average, that we are allotting the equal probability to all the prices. This is what I'm going to write down now. Or else we can write it like this: recent prices are more, should be given more importance. That's it. And this problem is solved by a new concept called as exponential moving average. Exponential moving average. And it has the formula like this: current price means the most recent price multiplied by the exponent, the highest probability, plus previous EMA means average of all the previous prices into 1 minus exponent. And the formula is very easy to understand. I will just explain it to you. First of all, current price in our case is 46, and previous EMA means the average of rest of the prices, means average of these four. Let's calculate it. Let's put 46 here, plus average of rest of the prices means 44 plus 41 plus 38 plus 40 divided by 4 goes to 40.75. This is the average of rest of the 4 days into. Now comes the concept of exponent. See, understand. Exponent is the probability. So for now, let's say that the probability is 0.33. Let's just say that. Or yeah, let's say the exponent is 0.33. And if we put down 0.33 here, you always know that 100% probability is written as 1, and out of that 1, if 0.33 is exponent here, probability, the rest of the probability comes to around 67%, which will be applied here, 0.67. Now this is one probability, this is another probability, the total will be 100%. If you can see that we have given 67% of the probability to 4 figures. 40.75 comes from the average of 4 different prices. Okay. And single 33% has been allotted to a single figure, which is 46. So on an average, if we talk about weights, we can say that 67 divided by 4, somewhere it's around 16 or 17%, 16.67%. Yeah, 16.75%. What does that mean? It means that we are giving, in exponential moving average, we are giving 33% weightage to recent price, and then 16.75% to all those price. Okay, if it is simple moving average. But I will tell you one more thing. It is only applicable for the first day. On the second day, you will take the previous day's EMA calculation. So what will happen automatically, I will not be able to show it here. Automatically, you will see the weightage is being decreased is in a descending order. So 33% to the recent price, this may have around 20%, this is 19, then 18, then 17, like that. So the most recent prices will be given more weightage than the oldest price, and that is what we want. The recent price is more important. So if we do the calculation here, roughly it comes to 27.30 and 15.18. So it is around 42.48, like this. Are you getting it? So in simple moving average, it was 41.80, and in our exponential moving average, it is 42.48. This is giving us a better picture. Now I'm confident that now you understand this formula. Current price is being given this probability, and rest of the probability to the previous EMA. We are going to solve it. Now comes the question, from where did you calculate this 0.33? The simple formula to calculate exponent, which you will have to remember, is E is equal to 2 divided by n plus 1. In our case, number of days were 5. We were calculating 5 days EMA. We were calculating, if we want to calculate 5 days EMA, it will be like 2 divided by 5 plus 1, 2 divided by 6, 33%, 0.33. It is like that. It is how you have to calculate. Okay. In institute, there is one more formula that they have given. And let's just go to the practical questions here. Have a look. Question number 1. Now we are going to start. Okay, before starting over to the practical question, I think we should once again look at the formula book, and you will see here the formula for simple moving average is nothing but 1 by n is equal to the summation of all the previous prices, or you can write this formula in this form: total of the closing prices divided by number of observation. It's a simple average which you were calculating till now from 10th or 12th class. Okay, then comes the exponential moving average. Exponential moving average is current price into exponent plus previous EMA into 1 minus exponent. So exponent means a single probability is given to the recent price, and rest of the probability is given to the previous average or exponential average. Okay, automatically this will result into the descending weights been given to the recent prices. Okay, let's solve a question on that. So if you come down to this closing values, so these are the closing values. These are the closing values of BSC, Bombay Stock Exchanges Index, which is Sensex from 6th to 17th day of January. Okay, for a certain year is as follows. You can see on 6th there was Thursday. It was a Thursday, and the closing prices are given in the last column. You can clearly see that on Saturday, Sunday there was no trading. Then Monday, Tuesday, Wednesday, Thursday, and again on Friday, Saturday, Sunday there is no trading. On Friday there might be some public holiday or something, otherwise there is no leave on that day. So it might be some public holiday, that's why the shares are not traded there. Now calculate exponential moving average of Sensex during the above period. Okay, we have to calculate EMA here. the 30 days simple moving average of Sensex can be assumed as 30,000. They have given this figure so that you can start calculating the EMA. The very first previous EMA in this formula will be 30,000, and after that whatever you have calculated on the previous day. Okay, the value of exponent for 30 days EMA is 0.062. The value of exponent 90% of the time will be given in the question, but it might also happen that it is not given, and at that time you will have to calculate the value of exponent as like this: 2 divided by n plus 1, 2 divided by 30 plus 1, 2 divided by 31, and the figure comes to 0.0645. Now you might say that, sir, the calculation that we have made and the figure that is given in the question is different. Obviously it is different. The more appropriate figure is this, but if certain figure is given in the question, use that only. Do not question the question, otherwise you will not get the marks. So use 0.062 only in this question, otherwise we would have calculated and used 0.0645. Now your formula that we learned is this, but in your institute's material this formula is given, which is the derivation of the following formula. What is the formula? Previous EMA plus current price minus previous EMA into exponent. It is the same thing and will give you the same answer. I will just show it to you here. So EMA is equal to current price into exponent, that was our formula, plus previous EMA into 1 minus exponent. This is our formula. We will just open up the brackets and it will look like this. Previous EMA into exponent. Getting it? Now you can clearly see that the exponent is common here. Okay, so first I will write down this, which is previous EMA, plus I will take a common figure out of these two, the first term and the last term, and in bracket we will just have CP and minus previous EMA. So current price minus previous EMA. That's it. This is the formula written in the question. Previous EMA plus CP minus previous EMA into E. So it is the same thing. Okay, how to solve the question? Let's just start with it. Write down the first date. Okay, 6th of January. The closing price was 29,522. Okay, to start with, the previous EMA will be 30,000. The same which is given in the question, just to start with. So first we will calculate the difference between these two, which comes to minus 478. 29,522 minus 30,000. I would personally recommend to use this formula, the last one which we learned, that is conceptual, because in that formula you are able to understand that the major probability, that is E, is applied to the recent price and rest of the probability is applied to the previous EMA, means the old prices. But it is very difficult to interpret this, the above formula, the first formula, because it is the derivation of this one, na? So instead of using this, use this. But in the institute's material, in this at least the answer given by the institute, they have used their formula. So that's what I am explaining right now. So you have taken the difference of it, you multiply the difference with the exponent, that is what is being done here. And once you have arrived at this, add the previous EMA in this. That's it. You will get the current EMA, the latest EMA. Now that EMA will become previous EMA for the next calculation. This EMA will become the previous EMA for the next calculation, and so on. Okay. I think now it's very easy for you to do the calculation. You just have to put the figures in the formula. I am not explaining how to put the figures in the formula. Okay. So I will just take this, the last column. Okay. Understand. The 29,970 was the exponent, exponential moving average. Then it went down. It decreased to 967, 29,967. Then it went up the very next day to 83. I'm just talking about the last two digits. 30,046, 30,130, 30,246, 416. You can see it is going up, 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 up. The only down movement came on the second day. Otherwise, it was all up. Also, one more thing that you need to understand, you don't have to calculate the EMA for the no trading days. No trading days, because it is going to be the same as previous EMA. Okay. So what should be the conclusion now? The conclusion is, as the exponential moving average is going up, 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 it shows a bullish trend. Let's read the conclusion. Have a pen with you. The market is bullish. Underline the word bullish. There are two things in which you need to understand. Bullish means the market is going up, and bearish means the market is going down. The prices are going to rise if we are saying bullish. The prices are going to fall if we are saying bearish. The market is likely to remain bullish for short term to medium term if other factors remains the same. On the basis of this indicator, investors should go long on their position, or can take long position. Now you should also write down one more thing here. Long means buy and short means sell. These are the terms used in the stock market, so you should be very familiar with these terms. Bullish means the prices are going to go up, bearish means the prices are going to fall, long means buy, short means sells. See, if you are expecting that the prices are going to go up, that means the price will go from 100 rupees to 105 rupees. It is very beneficial for us to go and buy the stocks at 100 rupees and then sell it at higher price. So we should buy when the market is expected to be bullish. When the market is expected to be bearish, we should sell. That's it. This is called as exponential moving average. Okay, one more thing that I should explain is this chart. You can clearly see one thing. Okay, this is a chart directly taken from some S&P 500 New York Stock Exchange. Okay. So this green line indicates, so first of all, let me explain what are the terms here. The black lines, the candlestick chart, I think it is. So these black lines indicates the stock prices, the closing prices and all that for all the days. The green line indicates the exponential moving average, 10 days exponential moving average. The black line indicates 50 days simple moving average. Red line indicates 100 days simple moving average. Now you just analyze all the three lines and you will see green line is more closer to the real stock prices on every day than the black and the red line. That means green line is giving you a proper picture or a perfect picture than the black and the red one. So more accurate data can be calculated with the exponential moving average rather than the simple moving average. That is what the difference is. Okay, that was just for the purpose of explanation. So we are done with question number 1. Question number 2 and 3 are similar in nature and you have to do it on your own. So that is homework for you. Last thing which we should take is question number 4 and 5, I think. Yeah, 4 and 5 is there. So question number 4 will be taken by us, which is on the new concept called as run test. So I will just take a break of some 5 minutes and I will be back to explain the concept of run test. To understand that this chapter constitutes some certain formulas which are technical in nature, especially the run test. We are not going to go into the derivation of those because first it is a fast track class. Second, we are the finance students. The exam is very near and the derivation of this run test formulas are not going to help you much. So you should understand it and we are going to understand the reason why we are applying this formula and what we are going to get, like how the results will be used. So let's just take the break and we'll be back on the run test concept. Okay, so welcome back after the break and right now I have a chart in front of me for the security analysis, and if you have the chart you should open it. So what I was talking about in the previous part was that this run test that we are going to start. Let me just remove it. This was all from the Hindi batch. Okay. So we are going to start with the run test now, and before understanding the run test we should understand the forms of market. There are three forms of market and efficient market. There are three forms of efficient market, and before understanding the efficient market, we should understand what is inefficient market then called as. So let's go to here and let me write down some figures. Let's say ABC is the stock whose market prices are on the very first day. It was, or let's say 5 days back, it was 30, then 32, 35, 37, 38. And today, let me just tell you, today, if the price is 40 and this price is derived or being calculated or is arrived on the basis of past information, then this price is of no use to anyone. What does I mean from this is, what do I want to tell you or explain you from this is, what is the sense of a market where anyone can predict the future prices based on the past data? Now tomorrow the prices will be somewhere near 42 and everyone is predicting like this. So there is one thing which is going on in here in this example is the prices are moving upwards. Bullish trend, and it will always be a bullish trend. Every investor is buying shares because the market prices are going to go up. Where are the sellers? And do you think it's a proper market where there is no seller? And if there are no seller, how come you are buying the shares? If nobody wants to sell, how come you are buying the shares? So this is called as inefficient market. You understand the market of vegetables? There are two parties effectively working or going there, sellers and buyers. You understand the market of electronics or furniture or any kind of market. The market is efficiently run by two type of people, the sellers and the buyers. If any one of them is missing, there is no use for the other type of person. Let's say, for example, I go to the market, in the vegetable market. I am the only one who wants to buy potatoes, mangoes and cucumber and everything, cauliflower, everything, but no seller is there. Do you think that is an efficient market? That is called as inefficient market. In the same way, in the stock market, if anyone can predict what is going to be the tomorrow's price, there will only be buyers but no sellers. And if there are no sellers, the buyers will not be able to execute their contract or their transaction. And there is no use. After a point, there will be no buyer in that market also. So that market won't be called as an efficient market. It will be called as inefficient market. Okay. So one thing is very clear from now onwards. When we talk about market, it can be efficient market. It can be inefficient market, right? Cool. You understood the concept of inefficient market. Is that means there has to be buyers and sellers both, and in order to be buyers and sellers to be present actively in that market, the prices should go sometimes according to the buyer, sometimes according to the sellers, and both of them should not know about it. Okay, so ultimately result comes down to, or conclusion comes down to this thing, that this prices should not, or we can indirectly say that this price of 40 should not be calculated based on these prices. So the past prices should be independent of the current prices, or sorry, I have just told it in a wrong manner. The current prices should be independent of the past prices. That means it should not be dependent on the past prices. Okay. Now comes the efficient market. What is efficient market? Where the buyers and sellers are actively participating in order to earn some profit. Efficient market can be divided into three different levels: weak form efficiency, semi-strong form efficiency, and strong form efficiency. Now, what is weak, semi-strong, and strong form efficient market? Now we are going to open the chart. Now you will understand weak form, semi-strong form and strong form efficiency. Okay. A market is said to be weakly efficient. It is efficient. It is a good market, but it is weakly efficient. Why? Let's say a particular share is trading at rupees 40 in this market or in a market, and that 40 rupees is the current price of the stock. Okay. Now, if I say that a particular market is a market where the current prices of 40 includes all the impact, whether it is going up or down, whatever it is, includes the impact of past information, or we can say past prices. If it already includes the impact of past prices, that means you as an investor cannot earn extraordinary returns based on this information, because this information is now irrelevant. Whatever the impact which has to happen because of this information or the past prices, it is already included in 40. Now what you are going to do with this information? Nothing. Is there any change that you are expecting in the current prices because of this information? No, because this is already included in this 40. And if it is so, the market is said to be weakly efficient. That 40 should only include the past prices and not the public information or private information. I will talk about it in a moment. Let's say if a market includes all the past information as we just discussed, but along with that, if it also includes all the public information like the balance sheets, the audit reports, notifications from the notifications or announcements from the companies regarding anything, mergers or anything. If the impact of such public information, whether it is prices going up or down, whatever it is, if the impact of such information, public information, is also included along with the past prices in rupees 40, then that market is called as semi-strong form market. It is now not just weakly efficient, it is semi-strong efficient market, because the prices in this market, the prices of the shares in this market includes the past prices, impact of past prices and impact of public information as well. That means as an investor, you have no use of these two information, the past prices and public information. Even if you have both the information with you, it's of no use to you, because whatever the impact, whether it is going up or down, whatever the impact that you are expecting because of these two information on the current price, it is already included in that. If it is already included, whatever decision you are going to take on the basis of these two information, do you think the prices will change? No, because we are saying it is already included. Then why it will change even more? No, it will not change. That means you cannot earn extraordinary return based on past prices and public information. Okay, so the tick marks represent that the information is irrelevant for you to earn extraordinary income in the respective market. If the current price is 40, and if we say that the 40 rupees includes the impact of past prices, impact of public information and something called as private information, which is not yet released in the market, that is called as insider trading, insider information. Let's say, for example, the company is going to announce or publish the results of their financial year the day after tomorrow, and that is not known to the public yet, and still you know about it. If you know about it, you have the private information of the company. If you know that the CEO of a particular company is in a hospital and he is going to die for sure, and the entire world doesn't know about it, that means you have the private information. And if that information is also included in 40, that means the impact of that information is also included in 40, then that information is useless to you. Suppose the CEO is going to die, and because of that the share price is going to fall, and that fall of 2 rupees from 40 to to 40 has already been included in the current price, then what you are going to do with that information that the CEO is going to die? Because whatever the change that has to happen because of that information is already included in the 40 price, and at that time the market will be called as strong form efficient, which is practically not possible. If I tell you, practically you won't find such type of market. You may find this market and this market, but not this strong form market, because private information is not included in the current prices in real life. Okay. Now, sir, if we cannot earn extraordinary income based on the past prices in weak form, based on the past prices and public information in semi-strong form, based on any kind of information in strong form, then why anyone would invest? My statement was, we cannot earn extraordinary income, but we can earn ordinary income with these information in any kind of market. Ordinary income is possible, sir. I was saying extraordinary income is not possible. So when do you say that extraordinary income is possible? When you have the public information or the private information in weakly efficient market, you can earn extraordinary return. When you have the private information in semi-strong form market, you can earn extraordinary return. It means if you have the private information in semi-strong market, that means this information can manipulate the price of 40. So you take the decision accordingly, because this information is going to soon going to be public, and then the prices will rise or fall, and you have taken the decision already. You will earn extraordinary return. The circles that I have made in that particular market will change the price, will affect the price in the coming time, and then you will be able to earn the extraordinary return. Okay, that was the concept. Now comes the weak form efficiency. We have to prove if the market is weakly efficient or not, and for that there are 3 different levels of test. Now what are those tests? Let's go to the institute's material, page number 3.30. You will see the thing that we discussed just now is this: level of market efficiency, weak form, semi-strong form and strong form. Cool. The 4th part is empirical evidence on weak form of efficient market theory. So first of all, let's revise what is weak form. It says that the current price of a stock reflects all information found in the record of past prices and volumes. This means that there is no relationship between past and the future price movement. It also means that the future prices and the past prices are independent of each other. That is what we have to prove, that whether past prices and future prices are independent. If they are dependent, then this situation will happen, that past prices are deciding the future prices, then anyone can predict the future prices, and then accordingly there will be only buyers or there will be only sellers. But if the market is weakly efficient, that means it is independent. Now there are 3 different tests that we can run in order to find out if the market is weakly efficient. This is serial correlation test. The first test, covered under question number 5, will be discussed in portfolio management chapter, because it covers the concept from that chapter. So we are skipping for now. There is no question on filter rule test as well in your entire syllabus, but the small part of it will also be covered in portfolio management chapter. It will be skipped for now. The only thing that we are going to discuss now is a run test, and how to do that. How to run a test where you will say that the market is weakly efficient or not. Okay, so now come down to, the question in your compiler. So question number 4 is there in your compiler, which we will see. So please, I request you to open that. The closing value of Sensex, have a look on that question. The closing value of Sensex for the month of October 2017 is given to you. Sensex is the index of Bombay Stock Exchange. You can clearly see that the dates are given here. On the first day, 2800 is the closing value. Okay. On second, there was no trading. Third, fourth, fifth, sixth and seventh, I think it was Friday and Saturday. So no trading and so on. The closing prices are given to you. Now what they are asking you to calculate, please have a look. Analyze the weak form of efficient market hypothesis. In order to analyze the weak form, we have three different tests: correlation test, run test, and filter rules test. Okay. But question is clearly specifying that you have to do it by applying a run test. Okay. And you have to do the testing at 5% and 10% level of significance. You remember the level of significance? The opposite of which was confidence level. Right, the same thing. Using 18 degrees of freedom. Now this degrees of freedom is used in T table. In T table, I'm not going deep into that right now. In T table, you will find the level of significance and degrees of freedom. So at 5% level of significance and 18 degrees of freedom, you will find the value of T. Also at 10% level of significance and 18 degrees of freedom, you will find the value of T, which is 2.101 and 1.734. So you can try. This is all testing, you know. So you can test at 5%, 10%. You can also test at 1% as well. Okay. Let's now start the question. So the closing prices are given to you. I'm going back to the chart and I will just explain you the steps that we have to do. There are 7 steps. First of all, you will calculate the total number of runs. Now, what do you mean by, sir, what do you mean by total number of runs? One run will complete when a trend of a price will reverse. For example, if the prices are moving up, and then it starts going down, then that up line will be called as one run. Let me just show you with the help of example. So just I'm drawing the price movement. So the prices were going up in this entire phase. This is called as one run. This is second run. This is third run. This is fourth run. So now you understand the runs. When a price change, or we can say when a trend of movement of the prices changes from going up to down or from going down to up, one run will be completed. So if the prices are moving plus, then minus, then plus, there are 3 runs in this. 1, 2 and 3. Getting it? In the similar manner, in this example, we have to calculate the run, number of runs, means how many price trends are there. Okay. So first we will calculate the number of trends that has happened. Then we will calculate how many times the prices moved up, or there are positive changes in the prices. Green signal. How many times? In the same way, we will calculate the negative prices. We will call it as N1 and N2. So first step is calculating these 3 things. R means number of run, N1 positive price changes, N2 negative price changes. With the help of these 3 figures, or specifically N1 and N2, we are going to calculate mean and standard deviation. If you remember, in Z table we discussed about mean and standard deviation. In the similar way, we have the formulas given here, and we are not going deep into it. Again, fast track batch, no sense in the derivation, and you don't have that much of the time also. So use the formula couple of times, 3 times, 4 times. You will have to mug it up, and then you can use it in the exam. And that too, the chances of coming up this question is only 1%, 1 or less than 1%. So use the data of N1 and N2, calculate the mean and then the standard deviation, and use the mean and standard deviation in order to calculate the last 2 steps, which is lower limit and upper limit. Understand? Lower limit is nothing but mu minus T into standard deviation. Mu and standard deviation is just being calculated by you. Mu plus T into standard deviation. So minus sign indicates the lower limit, plus sign indicates the upper limit. Calculate these 2. Now let me take an example that your lower limit comes to 6.26 and upper limit comes to 10.50, anything. And the number of runs that you calculated are 8. How to use the run test? We have explained all the steps, but how to use the run test? Now, if the number of runs comes in between the range of lower and upper limit, then we will say that the market is weakly efficient, independent of the past prices. In this question, you can clearly see that 8 lies in between these two figures. 8 comes in between 6 and 10, right? At that time, you will say that the market is weakly efficient. It means no one can predict the prices, because past prices, no one can predict the future prices based on the past information, because past prices are already included in the current prices. It's of no use now. The current prices or the future prices are independent of the past prices. But if your number of run comes to, let's say, 5, then we will say that it does not lie in between this range. It is out of the range, and at that time the market is weakly inefficient. It means the future prices are dependent of the past prices. Means the past prices are deciding the future prices. Then that inefficient market will happen. That is what we have to do. Now have a look. We'll just do it and we'll finish the question now. So you can clearly see that we have a table here. The dates are given in the first column. Then the second column for the closing prices. Because the first price, in order to start with, there is no change, because we do not have anything to compare the first price with, right? But the second price can be compared with the first one. And you can clearly see that the price has gone down from 800 to 780. That means a negative sign, because it is going down. But then immediately it went up the very next day, up the very next day, then down. So if it is going up, give it a positive sign as compared to the previous day. If it is going down, give it a negative sign. In that manner, complete the entire table. Now only focus on the last column. The very first thing that we should calculate is the number of runs, the price movement. This is one run. This entire price trend is second run. This is third run. I told you, number of runs finishes or closes when a price trend changes. So when it is going from plus to minus, the run will end. A particular run starts at this point and continue till the point the sign doesn't changes. So it will continue till here, and this will be called as fourth run, fifth run, sixth run, seventh run, and eighth run. Are you okay with this? Do you understand this thing? Okay. Now, let's calculate. We can clearly see that the total number of price changes are 8. That is 8 runs. Number of positive changes and number of negative changes. Have a look. Let's first count the number of positive changes. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11. Am I right? I have written all the numbers in front of the positive sign. So it is coming to total to 11. Then negative sign. 1, 2, 3, 4, 5, 6, 7, 8. That is it. So you can clearly see N1 is 11, N2 is 08. With the help of this first step, second step, and third step, you are going to solve the fourth one and the fifth one. So remember the formula, calculate the mu. 2 into N1, N2 means product of these two multiplied by 2 divided by summation of these two plus 1. You have the figure of mu 10.26. Then you have to remember this formula as well. There is one correction here, that the standard deviation given at the end should not have been there. So that's why I have crossed it, this one. Okay. So put down the N1, N2 values in this formula again and calculate the standard deviation, which comes down to 2.06. With the help of the mu that you calculated in the previous page and the standard deviation, calculate the lower and upper limit. So at 5% level of significance, 18 degrees of freedom, when the value of t is 2.101, you are going to calculate the lower and upper limit. The lower limit means mu minus t into standard deviation. Upper limit means mu into t plus t into standard deviation. Me plus t into standard deviation. So it is like that. Mu minus t standard deviation, mu plus t into standard deviation. Okay. So when you put down the figures, 10.26, 10.26, 2.06, 2.06 standard deviation, this is mu, this is t. You get the figure. Now tell me, your R was 8. Do you think 8 lies in between this? Yes, sir. 8 comes in between 5 and 14. Okay, let's change the level of significance. Let's test it at 10%. At 10%, 18 degrees of freedom, our t value will only change. It will not change the standard deviation and mu. So the new figure is 6 and 13. Do you think 8 comes in between 6 and 13? This is the number of runs. Yes, sir. R, that means 8, comes in between 6 and 13. So both the time we tested, both the time it lies, the result was that the number of run lies in between the lower and upper limit. That means R lies in between these limit. Hence the market exhibits weak form of efficiency. If it would not have lied in between these two, let's say for example your R would have been 5, at that time it does not lie between these ranges, we would have said that it does not exhibit weak form of efficiency, or we would have said that it is weakly inefficient at that time. Okay, if R would have been 5, but R is coming in between these range, and that's why we will say weak form of efficiency. Sir, how did you decide that this is going to be the rule, that if it comes in between we will say it is efficient? It is the formula, it is the method that has been prepared. Run test itself says that if it comes between range, a particular lower and upper range, then you say that the market is weakly efficient. There is a proper logic to it, but I don't think so. As a student, right now we should go deep into it, unless and otherwise you want to do PhD in that. Okay, question number 5 relates to the correlation test. It will be discussed in the portfolio management chapter, and for now we have finished the security analysis chapter in terms of practical question, but I would request you to do all the theory. Next chapter will be security analysis, security valuation. Next chapter will be security valuation. It is lengthiest in the terms of practical question. I would request you to complete the theory because it is not that big before starting the chapter. So next lecture will be on the security valuation. For now, bye bye.